Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Friday, May 15th, 2026, and this was a cautious risk-off session hiding inside a pretty normal-looking index print. Stocks broke from record highs as oil and treasury yields jumped. And that combo? It hit the discount rate trade hard. Semiconductors and high beta got sold first and sold hardest. The twist? Microsoft's strength acted like a life raft, so the indexes didn't fully show just how ugly the internals actually felt. Looking at the S&P 500 heat map, it was a deeply bifurcated board. Mostly red, with just a handful of bright green islands. The heaviest selling, semiconductors and industrials, just big intense red blocks. Energy was the one clean green pocket, and that masking effect was very real. Microsoft and Apple were green, while several other megacaps bled red, making the index level drop feel a lot smaller than the underlying liquidation. So, what explains that heat map? Violent money flow. Capital rapidly rotated out of high duration, high beta hardware, think AI semis and servers, and went right into two places at once. 1. Energy, acting as a commodities-linked inflation hedge, and 2. Megacap software, quality names perceived as much more durable when discount rates spike. Importantly, this wasn't your classic utilities and staples defensive stampede. No, this read like a massive positioning unwind in crowded AI trades, paired with a sharp inflation pulse through oil. Zooming out, the session's core tension got louder, not quieter. Energy-driven inflation pressure on one side stretched growth multiples on the other. Today, that pop in oil and yields forced multiple compression, and the funding source? Exactly what traders already owned, chips and high beta. And you could see the stress beyond equities too. Silver hit a sharp air pocket and crypto pulled back, both lining up perfectly with higher rate pressure and broader de-risking. On the chatter front, there wasn't any specific market rumor list going around today. So, we're not going to invent one. What did show up in the tape, though? Serious sensitivity around semis and policy headlines. If any new export policy or US-China headlines drop, traders are going to treat them as an accelerant, not a root cause. But for today's move, the clean read was simple. Oil up, yields up, and a massive positioning unwind. Microsoft was the standout stabilizer, closing up just over 3% on a day when risk appetite completely deteriorated. It caught a relative strength bid, basically treated as a quality shelter while hardware sold off. And that mattered. Why? Because it helped mask the broader index damage. When Microsoft holds up like this, it makes the headline numbers feel orderly, even as the rest of the tape is rapidly delivering. Nvidia dropped over 4%, and it read like the market's Fulcrum finally giving way. The driver here is straightforward. A semiconductor and AI unwind as yields rose, paired with heavy profit-taking in a very crowded trade. Throw in some real disappointment that US-China discussions didn't deliver clear chip export breakthroughs, and you get today's slide, and here's why it matters. When Nvidia breaks, the entire chip stack tends to deliver right along with it. AMD fell almost 6%. This was simply part of the broader semiconductor drawdown in a higher yield tape, a classic crowded trade unwind. The message here wasn't about stock-specific nuance. It was the market aggressively cutting exposure across the entire chip complex. AMD's move just reinforced the fact that traders were indiscriminately dumping risk in semis today. Supermicro sank over 6%, offering a crystal-clear window into today's momentum unwind. We're talking AI server and high beta hardware liquidation, hitting exactly at the same time as semis. This is one of those tickers that exaggerates the tape's emotion. When it gets hit this hard, it reads like fast money sprinting for the exits. Exxon Mobil gained over 3%, basically headlining the sector's leadership. The catalyst, energy taking charge on higher oil prices and massive inflation hedge flows. This matters because it was the absolute clearest expression of the session's chain reaction. Oil up, yields up, and tech, especially those long-duration semis, straight down. And one of the absolute loudest cross-asset signals today, silver, the SLV ETF plummeted over 8.5%. This all ties back to shifting rate expectations, higher yields and a stronger dollar just crushing precious metals. The sheer magnitude is what stands out here. It points to a violently aggressive positioning reset, happening right alongside the broader equity de-risking. Looking ahead, the economic calendar is your roadmap. Tuesday brings pending home sales. Wednesday gives us the FOMC meeting minutes. Thursday is completely packed, unemployment claims, the Philly Fed Manufacturing Index and flash PMIs. Then Friday closes out with revised consumer sentiment, but on the tape, the near-term tell is incredibly simple. Do yields and oil cool off, or do they stay firm? Because that is the exact pressure point behind today's multiple compression and the massive AI hardware unwind. Bottom line, today was all about the internals. The headline indexes fell, but breadth and participation were the real story. Energy shot up, while semis and cyclicals got hammered, and that Microsoft-led masking effect made things feel a lot calmer than they actually were underneath. Heading into the next session, keep it qualitative. Watch oil, watch yields, and watch whether the chip complex finally stabilizes or just keeps funding the risk reduction. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.